Exactly 1 year ago today, Donald Trump stood in the White House Rose Garden and announced the biggest tariffs in over a century. He called it Liberation Day. He promised foreigners would pay. He promised prices would drop, jobs would return, and the dollar would become unstoppable. 1 year later, the Supreme Court has struck down his tariffs as illegal. Inflation is still eating into your savings, and Stanford economists are warning that Trump's trade war may have caused permanent damage to the dollar's status as the world's reserve currency. Ray Dalio saw this coming. He warned for years that reckless policy and record debt would destroy global confidence in the dollar. And right now, in real time, that warning is playing out in every market on the planet. Stay with me, because you will understand exactly what happened, why it affects your money, and what the smartest institutions are positioning for. When Trump launched Liberation Day on April 2, 2025, the average U.S. tariff rate jumped from 2.5% to 27% overnight. The government collected $187 billion more in tariff revenue in 2025 than the year before. That is nearly a 200% increase. Trump told the American people that foreign countries would pay every dollar of that. He was wrong. Harvard and JPMorgan economists, nearly the entire cost landed on American businesses and American consumers. Companies either absorb the hit or pass the cost. JPMorgan now estimates that by 2026, businesses are passing 80% of all tariff costs straight to their customers. The Tax Foundation calculated an average of $1,500 extra per U.S. household this year alone. That is money coming out of your pocket. Then in February 2026, the U.S. Supreme Court ruled that the tariffs were illegal. The court said Trump had overstepped his authority. But even after that ruling, Trump did not stop. He immediately imposed a new 10% global tariff under a different law. Now here is the most important part. When Trump announced Liberation Day, something happened that broke a rule that held for decades. Normally, in global uncertainty, investors rush into U.S. dollars and bonds. But after Liberation Day, foreign investors did not buy dollars. They sold them. Stanford professors studied this and concluded, Trump's tariffs may have caused a permanent shift in how the world views the dollar. Former Treasury Secretary Larry Summers stated that U.S. assets were trading more like those of an emerging market. That is one of the most senior economic voices saying the dollar's throne is cracking. The numbers make that claim impossible to ignore. The United States is carrying $38.86 trillion in national debt right now. The deficit will hit $1.9 trillion in 2026 alone. Tariffs were supposed to fix that gap. But even at full collection, tariffs bring in $360 billion against a $1.9 trillion hole. The math does not work. This is precisely what Ray Dalio has been warning about. When a country prints money to cover deficits and erodes confidence, the outcome is always the same. Capital leaves, inflation persists, and gold rises. He called America's debt trajectory a heart attack. Gold had its best year since 1979 in 2025, hitting an all-time high of $5,595 per ounce in January 2026. Since then, gold has pulled back to around $4,758 today. And many retail investors are asking whether the bull market is over. The answer from the most powerful financial institutions is an emphatic no. Goldman Sachs and JPMorgan hold targets above $5,200 and $6,300. They looked at this pullback and called it exactly what it is, a temporary pause inside a structural bull market. These forces are far larger than short-term price moves. The shift toward gold and away from the dollar has only just begun. Those forces are central bank buying, de-dollarization, and record U.S. debt, and every single one of them has gotten stronger, not weaker, over the past year. 95% of central banks globally now plan to increase their gold reserves over the next 12 months. That is the highest share ever recorded by the World Gold Council. China is adding gold. India is adding gold. Malaysia and South Korea, which had been inactive for years, have resumed buying. These are not short-term trades. These are governments making a long-term strategic decision to reduce their dependence on the U.S. dollar and replace it with gold. That structural shift does not reverse because of one bad month in the gold price. It accelerates. Here's what to watch in the months ahead. The Federal Reserve is the single biggest variable. Right now, there is essentially zero probability of a rate cut in April, but Goldman Sachs and JPMorgan both expect the Fed to signal a pivot in the second quarter of 2026. When that happens, the dollar is likely to weaken, real yields will fall, and gold's recovery could move very quickly. The tariff situation is also still unresolved. Trump's current 15% global tariff under Section 122 expires in July 2026. What he does after that, whether he pushes tariffs higher or strikes trade deals, will directly shape the dollar's trajectory and gold's next move. The geopolitical picture adds another layer. The Iran situation, the ongoing US-China trade tension, and the continued acceleration of de-dollarization are all live variables that can shift markets sharply at any moment. The structural case for gold has not changed. The debt is still there. The deficit is still growing. The world is still diversifying away from the dollar, and the institutions that manage trillions of dollars are still positioned accordingly. 1 year after Liberation Day, the scorecard is clear. The dollar is weaker. The debt is higher. Inflation is still above target. The Supreme Court has ruled the tariffs illegal. The world's confidence in U.S. financial leadership has taken a hit that will take years to fully measure. Ray Dalio warned that this is how monetary systems weaken, not with one dramatic collapse, but slowly, through a series of decisions that each seem manageable on their own, until one day the trust is gone. Gold at $5,595 was the market's verdict on those decisions. The question now is what you do with that information. If this is the kind of analysis you have been looking for, subscribe to Crisis Alpha right now. Every video on this channel is built on real data and real forecasts from the world's top institutions: Goldman Sachs, JPMorgan, Deutsche Bank, the World Gold Council. No hype, no speculation, just the information that actually moves markets. Hit subscribe and turn on notifications, because when the next major move happens, you will want to know before the crowd does. Now I want to hear from you directly. Do you believe Trump's tariffs have permanently damaged the dollar's role as the world's reserve currency? Or do you think the dollar bounces back stronger from here? Drop your answer in the comments right now. This is one of the most important macro questions of 2026, and I want to know where you stand. I read every single comment, and I will personally respond to the most compelling arguments on both sides. And if you want the full picture on where gold goes from here, watch the next video right now. I break down exactly why gold crashed 23% in 2026, where the real technical floor is, and whether JPMorgan's $6,300 target is realistic or fantasy. It is the most data-driven gold analysis on this channel, and the one I recommend every new subscriber watches first. It is right there on your screen. Click it now.